Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about C.H. Robinson Worldwide Inc. Annual Report. C.H. Robinson Worldwide Inc. offers a diverse range of services that cater to various aspects of logistics and supply chain management. At its core, the company provides freight transportation services, including truckload, less than truckload, intermodal, and non-vessel operating common carrier services. These services enable the shipment of goods across different modes of transportation, such as land, sea, and air. In addition to transportation services, C.H. Robinson also offers logistics services that include customs brokerage, warehousing, and fee-based managed services. The company's expertise in managing complex supply chains is further enhanced by its ability to organize air shipments and provide door-to-door services. The company's portfolio of services extends beyond traditional logistics to include the buying, selling, and marketing of fresh produce under the Robinson Fresh trade name. This segment allows C.H. Robinson to connect growers with retailers, restaurants, and distributors, providing a seamless supply chain for perishable items. Overall, C.H. Robinson Worldwide, Inc. is a comprehensive logistics solutions provider that offers a wide range of services to meet the diverse needs of its clients across various industries. C.H. Robinson Worldwide, Inc.'s stock price skyrockets by 98% in 1 year. The past year has been a remarkable period for C.H. Robinson Worldwide, Inc., with its stock price climbing nearly 98%. This substantial increase can be attributed to the company's consistent financial outperformance and strategic advancements amidst a challenging freight market. One key factor contributing to this surge is the company's ability to consistently beat analyst expectations for adjusted earnings per share, EPS, in all 4 quarters of 2025. This demonstrates C.H. Robinson's capacity to navigate a soft freight environment more effectively than anticipated, signaling its resilience and competitive strength. The implementation of a new lean operating model and the increasing integration of lean AI across its operations have been instrumental in driving market share gains, expanding gross margins, improving operating leverage, and enhancing productivity. This strategic execution has allowed C.H. Robinson to expand its market share despite a global decline in freight demand. The company's strong cash generation and shareholder returns have also played a significant role in the stock price increase. Consistent cash dividends and significant stock repurchases have demonstrated the company's commitment to returning value to shareholders. Furthermore, the upward revision of C.H. Robinson's operating income target for 2026 has signaled management confidence in the continued positive impact of its strategic initiatives on future profitability. Positive analyst sentiment, including reiterations of buy ratings and upward revisions of stock price targets, has also contributed to the stock price surge. Overall, C.H. Robinson Worldwide, Inc.'s remarkable financial performance and strategic advancements have driven its stock price increase by nearly 98% in 1 year. C.H. Robinson Worldwide, Inc. market capitalization of $21 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that C.H. Robinson Worldwide, Inc. holds a significant advantage in their industry. C.H. Robinson Worldwide, Inc. trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 11.43 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, several key elements contribute to increased revenue. The expansion of lean AI technology and its application in industry have been significant contributors. Additionally, the enhanced dynamic costing and pricing models have also played a crucial role. Furthermore, the growth in transportation services, including truckload, less-than-truckload, ocean, air, and rail shipping, has been substantial. The launch of C.H. Robinson Managed Solutions in November 2024 has also driven revenue growth. On the other hand, several factors have led to revenue decline. The sale of Europe Surface Transportation business in February 2025 was a major contributor. Decreases in LTL services revenue and air services revenue have also been significant. Furthermore, lower pricing and volume in ocean services, as well as lower fuel surcharges in truckload services, have contributed to the decline. The divestiture of Europe Surface Transportation business has also had a negative impact on revenue. In summary, while several factors contribute to revenue growth, including the expansion of lean AI technology and transportation services, the primary drivers of revenue decline are largely related to the sale of certain businesses and decreases in specific service revenues. The net income of the company underwent significant fluctuations between 2023, 2024, and 2025. In 2024, the net income decreased by 41.8% compared to 2023 due to a decline in volumes and freight rates, increased working capital needs, higher carrier prices, and operating expenses. However, in 2025, the net income rebounded with a substantial increase of 26.1% from 2024, reaching $587,081. This growth was largely driven by strong operating performance and a reduction in ocean freight costs. The profit margins also experienced changes during this period. The operating margin decreased by 25.7% in 2024 compared to 2023 due to the same factors that contributed to the decline in net income. Conversely, the adjusted operating margin saw a significant increase of 490 basis points in 2025 compared to 2024, reaching 29.1%. This improvement was largely attributed to the reduction in ocean freight costs and strong operating performance. Additionally, the total adjusted gross profit margin increased by 120 basis points in 2025 compared to 2023, from 14.8% to 16.8%, indicating a positive trend in the company's profitability. The company's financial performance indicates a positive trend in operating cash flow. According to the provided data, the company generated $914,519 in operating cash flow for the year 2025, representing a significant increase of 79.6% from the previous year's figure of $509,084. This upward trajectory is further supported by the comparison with 2023, where the operating cash flow decreased by 30.4%. The consistent and substantial growth in operating cash flow suggests that the company is efficiently managing its operations to generate positive cash flows. The financial performance of various segments and regions within the company has been analyzed. In terms of strong performance, the Europe Surface Transportation segment showed no indication of poor results. The Global Forwarding segment also demonstrated improvement, with a decrease in depreciation and amortization from $19.33 million to $9.09 million, as well as a reduction in average employee headcount from 5222 to 4284. On the other hand, several segments and regions struggled. The North American Surface Transportation (NASD) segment did not provide any performance metrics, making it difficult to assess its performance. The All Other and Corporate segment saw an increase in depreciation and amortization from $56.63 million to $74.38 million, indicating a decline in financial health. Additionally, the U.S. region experienced a decrease in total revenues from $14,795,659 to $14,339,494. Segments such as Other Surface Transportation outside of North America and Robinson Fresh and Managed Solutions also did not provide any performance metrics, leaving their performance unclear. Overall, these results highlight areas where improvement is needed and opportunities for growth within the company's various segments and regions. Management is emphasizing a long-term approach to business, focusing on building strong relationships with customers and expanding market presence. They are confident in their ability to drive digital transformation through investments in areas such as AI, machine learning, and data science. The company's competitive advantages include its people, global suite of services, scale, lean AI, data, and technology. Management is prioritizing investments that will grow market share, expand globally, and digitize customer, carrier, and internal tools. In terms of strategy, management is focusing on competitiveness, clarity in benefit programs, and aligning compensation with company goals for sustainable growth. They are also emphasizing environmental sustainability efforts, community engagement, and philanthropy. The company's financial performance is expected to continue strong, with capital expenditures anticipated to be approximately $75 million to $85 million in 2026. Management remains committed to quarterly dividend and share repurchases to enhance shareholder value. A new restructuring program has been initiated to enhance operational efficiency and achieve cost savings through the adoption of advanced technologies, including AI. This program is expected to materially reduce the company's cost structure and better position it for sustainable, long-term growth in an increasingly technology-driven marketplace. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, C.H. Robinson expanded its services by acquiring Phoenix International in 2012. Additionally, the company also acquired transportation services from Slash to competitors, further enhancing its capabilities in this area. On the other hand, the company has also undergone divestitures to streamline its operations and focus on core areas. One notable example is the sale of its Europe surface transportation business to an undisclosed buyer for $44.5 million pre-tax loss, effective February 1, 2025. This move marks a significant shift in the company's strategy as it looks to concentrate on other areas of growth. The company's financial activities have been notable for two key initiatives. Firstly, it has a history of paying dividends to its shareholders. This practice was evident in the years 2024 and 2025, where cash dividends were distributed amounting to -$294,772 and -$301,376 respectively. In addition to dividend payments, the company has also engaged in share buybacks as part of its strategic efforts. Under its share repurchase program, it has successfully repurchased shares in both 2023 and 2025. Specifically, in 2023, the company bought back 645,753 shares, while in 2025, it acquired a significantly larger number of shares at 3,093,915. Supply chain disruptions. A growing concern. The extracted summaries reveal significant concerns regarding supply chain disruptions. The transportation industry is particularly vulnerable to disruptions due to factors such as freight levels and costs, equipment and driver shortages, port congestion, labor shortages, and regulatory changes, page 14. Additionally, geopolitical factors, wars, civil unrest, acts of terrorism, and other global conflicts can also impact the supply chain, page 20. The ocean freight market has already experienced disruptions that have affected air freight services, leading to declines in total revenues and direct costs, page 32. Furthermore, other surface transportation, adjusted gross profits decreased by -92.4% in 2025 compared to 2024, indicating potential supply chain disruption issues, page 33. While there are concerns about supply chain disruptions, there is limited mention of inventory buildup. However, it is worth noting that some companies may be holding onto inventories consisting primarily of produce and related products for resale, page 47. Overall, the data suggests that supply chain disruptions pose a significant threat to businesses, and proactive measures should be taken to mitigate these risks. That concludes the financial summary for C.H. Robinson Worldwide Inc. Feel free to comment below, and I will be happy to answer them when possible.